And I think what Powell did that kind of reinforced the reason that they made the turn, they pointed to overseas, and that was really the biggest risk for the market. You know, you look at China, their manufacturing sector is in economic contraction. Europe is a rolling revolution from one country to the next. Germany is on the cusp of a recession, and you got Brexit coming up. Right now, that geosynchronous growth that we were so excited about 18 months ago has morphed into the United States as the best house on the block.
Oh, well, we were terrified of a geosynchronous, as you might say, slowdown 60 days ago. Suddenly, everything's great. The best start to a year since 1987. What flipped?
Well, the world hasn't flipped, but the Fed has flipped, clearly. You know, that rhetoric is
The doves have flown.
They have completely changed course. And to his credit, he understood that what we saw last year, that was a policy mistake.
He being Jay Powell?
Jay Powell. He made a policy mistake. He reversed course, and that's unusual for the Fed. They're usually slow acting. They saw they made a mistake, and I applaud them for that.
What was the mistake?
Certainly raising the interest rates in the face of no inflation wasn't necessary. Now, I do disagree with what they're doing with the balance sheet. Perhaps $50 billion a month was clearly too much for the markets, but now to walk it back to nothing, we're going to stop at $3.5 trillion. That's significantly above where we were, you know, before the financial crisis. And then if you try to hold it there, that implies that you're actually going to have to go back into the market and buy more debt.
But does that tell you we're in a strong market? If the Fed threatens or moves the punch bowl slightly away and the markets fall like they did in December, is that a healthy market?
Not as healthy as if we could sustain 4 or 5% interest rates, but perhaps we can't. But I think even Warren Buffett said on this network, if rates stay low or anywhere near where they are right now, stocks are cheap.
David, this has been one of the strongest economies in over a decade.
Yeah.
If we can't withstand 3 or 4% on the Fed funds rate,
look around the world,
us?
Brian. You know, we're not the only game on the planet. You know, we don't live in a vacuum. Interest rates around the world are very, very low. You push our rates up on the long end here. With rates there in Germany, that's still good sovereign paper. They're going to come over here to buy our debt, and it helps put a lid on our rates.
It is a global market, and that's why this show is called Worldwide Exchange. Finish my sentence for me.
Okay.
The biggest risk to the market, to our viewers' money, is?
Overseas.
Where?
The slowdown.
It's a big world.
Brian, 40% of S&P 500 revenue is offshore. All right. If those markets slow down, if China remains slow, and it's not just trade that is hurting China, if Europe remains slow, you've got Brexit coming up, eventually it has to hit the top and bottom line of U.S. companies here. I think we're doing astoundingly well in the face of that.